Hi, in this video we will look at an old exam question, a life insurance exam question. It appeared in the ST2 exam, September 2007, rather old exam question number 4. The aim in this video is to talk about surrender value, that is the calculation of the surrender value. Okay, let's read the question. A man purchased a without profits endowment assurance. Okay, endowment assurance with a 25-year term on his 40th birthday. The sum assured is of £50,000 is payable at maturity or at the end of the year of death if earlier. He pays a premium of £1,000 annually in advance. He has just reached his 50th birthday and has not yet paid the premium due at that date. So he has just reached his 50th birthday. Again, right before we move on, we are dealing with endowment assurance, 25-year term, 40th birthday. Yeah, so 25-year term sold to somebody on his 40th birthday. The sum assured is £50,000. A premium of £1,000 is payable annually in advance. So he has just reached his 50th birthday. So we're looking at 40. Now he is 50. This is a 25-year term. So we have 65. Okay, great. He has decided that he no longer wishes to use this type of policy for the purpose of savings and would prefer to invest directly in equities. He has therefore requested a calculation of the surrender value and paid up sum assured for this policy. We will work with the paid up sum in a separate video. You are told the insurance company calculates surrender values using a prospective calculation. We have learned that before. It's either prospective or retrospective. Paid up sums assured are based on an equation of value using the surrender value as the current policy value. Okay, so we leave the paid up sums for a later time. These are the following assumptions used. Mortality M92 ultimate. Interest rate is 6%. Renewal expense is £35 per annum for premium paying policies. Renewal expense inflation is 1.92% per annum. This number should ring a bell from our contingency days. Okay, when I mean ring a bell, I'm talking about this 6% and this 1.92%. It should ring a bell. Yeah, when combined, looks like we're going to get a 4% thingy, but never mind, let's read on. So renewal expense inflation is 1.92% per annum. Claims expense 0.5% of benefit on death and maturity, and then you have an alteration expense, £100 on surrender and alteration. So we're asked to calculate the surrender value to which this policyholder would be entitled. Okay, parts 2 and 3, we will look at it in a separate video. Let's look at my solution. Yeah, I've written down all the important points here. Endowment assurance, I have a timeline here, 40, 50 and 65. And then we are looking at a prospective calculation. The sum assured is £50,000. The premium is £1,000 per annum. Interest rate 6%. Renewal expense 35 per annum. And expense inflation. All the important facts are here. Okay. There's also some information here which I've copied it from the top. Okay. So the surrender value. What's the main idea? It will be the expected present value of your outflow minus the expected present value of your inflow. That's the idea. Okay. So the expected present value, well, of the outflow, which is your future benefit. Okay. The expected present value of your future benefit will be this. Now, why is this here? That's because we have a 0.5% claim expense. Okay, let me bring that down again. Remember, the claims expense is 0.5% of benefit on death. So 0.5% combining it with your death benefit, you'll have 1.005 times this thing here. Yeah, the expected present value. The amount is $50,000, so you multiply by 50,000. And then you have a renewal expense of 35 per annum. That's what you see here. 35 A dot dot 50 angle 15. Be careful, this one is calculated at 4% because our interest rate combining with our inflation rate, remember this formula, 1 plus I over 1 plus B minus 1, so it'll be 1.06 over 1.0192 minus 1, you will get 4%. So this is worked at 4%, this is worked at 6%, and then we have your premium. Okay, this is your remember, this is your outflow. Now you have your inflow, right? So inflow, you will have your premium, 1000 times A dot dot 50 angle 15. Careful, this is worked at 6%. Okay, and then we have your, remember the last line, we called it the alteration expense. Let me bring it up. The alteration expense is £100 on surrender and alteration. So we have this inflow. Careful, this is minus. Okay, careful, this is minus. Account mistake would be to add it. This is minus. And then all you have to do is use your tables, draw down on the values. Okay, 50,000 times 1.005, and then this value here that you see, and then we have another value here for your A dot dot 50 angle 15. Use the right tables. One is at 4%, this one is at 6%. Use a calculator and you will get 11,954.3 pounds, and we are done.